Welcome to the Change Advisory Board, also known as the CAB Call. This podcast is brought to you by Nicholas King and Columbia Cloudworks.
Glad to be here for this one.
Yeah, today we are opening up a rather unique set of dossiers. You could call this an exercise in professional opposition research.
Oh, absolutely. It's a completely different way of looking at corporate strategy.
Right, because, if you follow technology at all, you were just bombarded daily by executive keynotes, right?
Yeah.
Earnings call projections, these massive visionary press releases.
The hype cycle is relentless.
It really is. And we're all conditioned to treat these statements as, well, probabilistic forecasts. Like they're actually doing the math on the future.
Which is the first major mistake you can make.
Exactly. Because when you run a rigorous meta-analysis on what these technology executives publicly predict versus the measurable market realities that actually follow, the stuff that happens years later, you realize we aren't looking at financial forecasting at all.
No, not even close.
We are looking at pure narrative engineering.
It is a profound divergence. And to analyze that divergence systematically, our source documentation today utilizes this really fascinating architectural framework.
I love this framework.
It's great, right? It uses a masonry metaphor to categorize exactly how executives behave when their bold predictions inevitably fail.
Right. They call it the Divergence of Executive Intent.
Yes, and it breaks down into 4 structural components that we're going to use to guide this entire deep dive.
So let's lay those out for the listener. The documentation labels the first component, the plumb.
Like a plumb line in masonry.
Right. In masonry, a plumb line establishes absolute verticality. It's the standard. So in corporate strategy, the plumb is the executive's initial strategic intent.
The stake in the ground.
Exactly. It's that forward-looking forecast, the grand promise.
And then you have the second component, which is the level.
The harsh reality.
The cold, hard accountability of it all. The level is the empirical data. We're talking SEC filings,
Right.
actual product delivery dates, the measurable financial outcomes.
Basically, the level is gravity.
Exactly. Gravity always wins. Which brings us to the third tool. And, this is arguably the most utilized tool in all of Silicon Valley.
Oh, without a doubt. The trowel.
The trowel. So when the plumb and the level completely fail to align, when that bold prediction just violently misses reality, the trowel is the rhetorical mortar they use to smooth over the cracks.
It's the narrative concealment technique.
Right. It's how they reframe a massive multi-billion-dollar forecasting failure as a mere macroeconomic headwind.
Or a strategic evolution. I love that one.
Oh, yeah, they love strategic evolution.
And when the trowel is applied, it usually points toward the fourth and final component, which is the Ashler.
A finely dressed, perfect stone.
Yes. The Ashler is the perpetually promised, perfected future state of the technology. It's the utopian vision that justifies whatever the current failure is.
And it's always, conveniently, just 3 to 5 years away.
Always. Every single time. So that framework, plumb, level, trowel, Ashlar, that is the lens we're using today. Because when you apply it to the source dossiers on figures like, Amazon's Andy Jassy or Tesla's Elon Musk.
Air Force's Mark Benioff.
Right, or Intel's Pat Gelsinger. You realize these executives are rarely executing rigorous risk assessments.
They are running modern political campaigns. That's what it is.
Exactly. These forecasts are engineered to do 3 things. Attract massive capital, suppress market competition by making rivals look obsolete, and secure internal compliance from their own workforce.
It's a psychological operation as much as a business strategy.
So let's dissect the actual anatomy of a failed corporate tech forecast, because the sources identify several really distinct behavioral patterns here.
Starting with pattern 1, which the dossier calls maximalist framing and artificial timelines.
Yeah, executives at this level, they don't hedge at all.
Never. They speak in terrifying absolutes.
Andy Jassy's tenure at Amazon Web Services is a prime example of this, right?
Oh, absolutely. For years, his plumb was this aggressive binary position. He basically said any enterprise refusing to abandon their on-premise data centers was behaving irrationally.
I remember in 2016, he infamously stated that companies resisting the cloud were fighting gravity.
Fighting gravity. Think about the arrogance of that framing. He declared this absolute vision of moving to a 100% full cloud operating model.
But, the level of reality in enterprise IT is vastly more complex than that. An enterprise isn't just a single marketing website you can just lift and shift.
Right. We're talking about legacy systems.
We're talking about legacy mainframes running decades-old COBOL code, that process, like billions of dollars in daily banking transactions.
You can't just throw that on a public cloud server over the weekend.
You literally can't. And we're talking about data gravity. If you have petabytes of proprietary data, moving that over network pipes is physically and financially prohibitive.
The egress fees alone would bankrupt a mid-sized company.
Exactly. And what about strict, localized data sovereignty? Like European healthcare providers legally cannot move certain patient records across borders.
Right, the compliance issues are massive.
Jassy knew all of this. He had to. But the subtext of his maximalism wasn't just that the cloud was good, it was a psychological weapon.
Yes. It was designed to make CIOs feel like they were going to get fired if they didn't immediately rip out their server racks.
It creates this totally artificial, self-fulfilling panic.
And you see the exact same maximalist methodology from Elon Musk.
Oh, the king of the maximalist Plum.
Right. I mean, he doesn't get on stage and say, we're making iterative progress on advanced driver assistance systems, and we hope to handle some edge cases in the next decade.
No. He issues definitive time-bound declarations. Full autonomy by Q4 2017.
1 million robotaxis on the road by 2020.
Which is just, I mean, the engineering reality of level 5 autonomy is a staggering physics and software problem.
Because you're asking a car to handle every single infinite edge case.
Yeah. Yes. Human biology, unpredictable weather, some localized construction site with a guy holding a cardboard stop sign, doing all of that without human intervention.
And doing it purely on vision-based neural networks.
Right. Relying purely on vision without LiDAR redundancy means you have to train the system on a practically infinite data set of unpredictable physical events.
It's mathematically nearly impossible to solve for every variable.
Musk knows the math on this. He employs the smartest engineers in the world, yet the plumb he sets is absolute.
Because the absolutism is the point. And we cannot ignore Pat Gelsinger at Intel here.
Oh, wow. Yeah. The Intel turnaround that wasn't.
Right. So he stepped into a company that had completely lost its manufacturing leadership to TSMC in Taiwan.
They were bleeding market share.
Severely. His mandate was a total turnaround. But he didn't just pledge, basic operational improvement. He confidently promised to deliver 5 no's in 4 years.
I really want to break down how absurdly maximalist that is for any of our listeners who might not track semiconductor fabrication day to day.
Please do, because it's mind-boggling.
A node refers to a generation of manufacturing technology. It's essentially how small you can shrink the transistors on a silicon wafer.
We're talking microscopic levels here.
Beyond microscopic. Moving down just a single node, say, going from 7 nanometers to 5 nanometers, usually takes years of solving fundamental quantum physics problems.
It's not a software update, it's material science.
Exactly. You are dealing with extreme ultraviolet lithography machines that cost hundreds of millions of dollars each. You were trying to print patterns almost at the atomic level.
And Gelsinger promised to do this 5 times in 4 years.
Culminating in the 20A and 18A nodes. The A stands for angstroms, which is 1/10 of a nanometer.
He was promising to implement gate-all-around transistor architectures and backside power delivery simultaneously.
In the level. The reality of that promise.
The 20A node was unceremoniously canceled.
Poof, gone.
And the subsequent reports on the 18A node indicated yields of less than 10%.
Which is just catastrophic for a commercial foundry.
Completely unviable.
A yield of 10% means that 90% of the microchips you just printed on this incredibly expensive silicon wafer are defective garbage.
You're literally throwing money away.
You cannot run a profitable fabrication plant when you are throwing 9 out of 10 chips in the trash. The physical reality entirely crushed his maximalist plum.
But here's the thing. The function of the maximalism served its initial purpose perfectly.
How so?
Well, if Gelsinger had stood on that stage and said, look, we are going to try to stabilize our current manufacturing process and maybe catch up to TSMC in a decade, he wouldn't have commanded any initial market momentum.
His stock would have tanked.
Exactly. The absolutism generates the capital. It rallies the troops. But what is truly fascinating is the behavioral pattern that kicks in when the timeline inevitably passes and the failure becomes entirely public.
Which the dossier's label as pattern 2, the silent pivot and the lack of retraction.
Yes. This is crucial. Executives almost never issue a formal retraction of their forecast.
There is no press conference where they say, hey, my bad, I was wrong.
There is no mea culpa. They just deploy the trowel.
Mark Benioff at Salesforce provides a literal textbook study of this behavior.
He really does. Let's look at 2025. Heading into a highly volatile tech labor market, Benioff was actively, publicly dismissing fears of AI-driven job displacement.
I remember his interview on CNBC in early 2026. He pushed back hard against warnings of mass tech layoffs.
He said, "I just do not see it." And he went further. He categorized CEOs who were cutting costs as taking the lazy way out.
He was setting a highly moralistic Plum, positioned himself as the benevolent leader.
But almost immediately after insisting AI would not lead to a white-collar wipeout, Salesforce executed 4,000 layoffs.
Just a massive cut.
The contradiction was absolute. The level just totally broke the plumb.
And the response from Benioff.
The silent pivot, the trowel was heavily applied. The narrative shifted instantly from this moral stance on employment to market alignment and operational efficiency.
The CNBC interviews were quietly retired from the corporate messaging, I assume.
Exactly. The failure of the forecast is simply absorbed into a new corporate necessity. Nobody apologizes.
You know, I look at these repeated, massive failures. Jassie's cloud gravity, Musk's robo-taxes, Gelsinger's 5 nodes, Benioff's layoff denials. And I just keep coming back to a structural question.
Which is?
If these predictions fail so consistently and so spectacularly, why does the market continue to price them into valuations?
It's the multi-billion-dollar question.
Right. Institutional investors are not stupid. They employ armies of quants. They know the math better than anyone. So why do they actively reward this behavior?
Well, our sources address this directly in Pattern 3, the Wall Street feedback loop.
This part is so revealing.
It really exposes the machinery. They analyze Meta's $30 billion bond offering alongside their staggering $75 billion AI infrastructure expenditure, and they arrive at a vital conclusion. Wall Street does not predict the future. It narrates the present.
That is such a critical distinction for you, the listener, to internalize. Wall Street narrates the present. It is a massive groupthink dynamic.
Let's look at the timeline. When Meta's stock was up 60% year-to-date through late October, all of that massive $75 billion AI capital expenditure was narrated by the financial press and analysts as visionary leadership.
Right. Mark Zuckerberg was out there buying up hundreds of thousands of NVIDIA H100 GPUs.
Building out massive, insanely power-hungry data centers. And the market applauded the boldness.
He's securing the future.
Exactly. But then the stock dropped 11% in a single day. Suddenly, overnight, that exact same infrastructure spend was narrated as reckless gambling.
And the sources point out the absolute absurdity of that single day. Not a single analyst downgrade issued that morning contained new material information.
None, zero.
They cited ROI uncertainty. They compared the AI spend to the previous cash burn of the whole metaverse project. They cited the fact that revenue acceleration wouldn't happen until 2026.
But every single one of those facts had been true and publicly known for 6 months.
Right. The math didn't change overnight. The momentum changed.
Because the incentive architecture of the market actively rewards boldness over accuracy. Wall Street is caught in the identical narrative distortion field as the executives themselves.
Meta believes they have to build out this physical infrastructure right now, securing the real estate, the power contracts, the silicon. Or they think they'll be structurally locked out of the AI future forever.
And investors are terrified the returns won't manifest for a decade. I mean, even Zuckerberg admits super intelligent AI might be 5 to 7 years away or longer.
So the analysts just play along while the stock chart points up, and they feign shock and demand accountability the very moment the chart points down.
They are not holding executives to probabilistic accountability. They are merely reacting to momentum.
Which brings up a very practical problem for you listening to this. If the technology CEOs are running political campaigns, and the Wall Street analysts are just writing reactive fan fiction about the present momentum.
Where do you find actual objective forecasting?
Exactly. How do you spot institutional bias in a report?
Well, our source material provides a brilliant parallel example completely outside of the tech industry to illustrate exactly this point.
Yeah, so we need to talk about the oil lobby.
We need to look at the massive lobbying effort surrounding the crude oil export ban and directly contrast it with the risk assessment models from Deutsche Bank.
This contrast is essential to understanding how the Trowel operates at an institutional level. Because it's not just CEOs. Entire industries do this.
For context, there was a multi-year, highly contentious debate in the United States over lifting the decades-old ban on exporting domestic crude oil.
A huge political fight.
Massive. And unsurprisingly, a massive ecosystem of macroeconomic studies suddenly appeared out of nowhere to inform policymakers.
The sources list the organizations involved. We're talking about the American Council for Capital Formation, the American Petroleum Institute, IHS Energy, ICF International, NERA Economic Consulting, the Brookings Institution,
It was a highly coordinated flood of
a
data.
barrage of PDFs hitting Washington.
And if you actually read those reports, the conclusions were miraculously unanimous.
What a shock.
Right. They all arrived at the exact same perfected Ashler. They concluded that if the government lifted the crude oil export ban, it would magically lower domestic gasoline prices at the pump,
It would significantly boost U.S. GDP
stimulate heavy manufacturing.
and vastly improve national security.
It is the ultimate Plum, a corporate strategic intent dressed up as inevitable, frictionless economic science.
But when you look at the mechanics of how these macroeconomic models are constructed, the trowel work is incredibly aggressive,
Heavy troweling.
extremely heavy. They built these models by systematically smoothing over ground-level reality.
The primary technique was the deliberate omission of negative variables.
Let's pretend they don't exist.
Exactly. These reports push the macroeconomic benefits while entirely ignoring the localized environmental degradation and the severe localized logistical friction that actual oil extraction requires.
They use highly generalized data points to paint an overly optimistic, frictionless utopia.
Let's talk about that localized friction, because the sources detail exactly what was happening on the ground in places like the Williston Basin in North Dakota.
Yeah, let's get into the weeds here.
Yeah.
Because the macroeconomic models assumed a clean, mathematical increase in production, like a simple line graph going up.
They completely ignored the reality that state regulators on the ground were completely overwhelmed.
The North Dakota Industrial Commission had limited staff. They were operating on these antiquated IT systems from, like, the 90s.
And they were forced to compete with the oil producers themselves for basic labor.
Right, because a roughneck can make vastly more money pulling shifts on a rig than auditing environmental permits for the state.
So the state literally can't hire people to regulate the boom.
Because of this, regulators were only collecting roughly 10% of the fines they actually assessed for infractions. 10%.
It's lawlessness by attrition. And the models completely ignored the destruction of local road infrastructure from all that heavy truck traffic.
They ignored the massive housing shortages.
The severe strain on local emergency services.
All of it. Erased. Because the objective of an American Petroleum Institute report is not to accurately model localized risk.
No, the objective is advocacy disguised as analysis.
It is lobbying.
Yeah.
Pure and simple. The models were constructed specifically to yield a predetermined political result.
Now, I want you to contrast that methodology directly with the Deutsche Bank Asset Allocation Report.
It is an entirely different architecture.
Completely different universe. The Deutsche Bank Research Department operates under entirely different commercial imperatives.
They aren't trying to pass a law.
Right. They maintain strict regulatory information barriers separating them from the investment banking side of the firm to prevent conflicts of interest.
Their audience isn't a politician looking for a talking point. Their audience is a fixed-income portfolio manager.
Exactly. Deutsche Bank is analyzing risk for investors where getting the forecast wrong results in catastrophic financial loss.
Let me put this in perspective. If I am an institutional investor and I am long on fixed-rate instruments, say I hold billions of dollars in 10-year bonds paying a 3% coupon.
A massive illiquid position.
Right. And say I rely on a rosy economic forecast, like the ones the oil lobby puts out, that inflation will stay perfectly low.
But then reality hits, the level hits.
Inflation spikes. Central banks are forced to raise interest rates to 5%. Suddenly, the new bonds hitting the market are paying 5%.
Which means your 3% bonds are practically worthless by comparison.
The mathematical reality is that the discount factors applied to the expected cash flows of my 3% bonds increase drastically. The secondary market value of my portfolio gets absolutely crushed.
You lose real, measurable capital. Millions, maybe billions.
Therefore, a fixed-income investor cannot accept an Ashler. They don't care about the utopian vision.
They cannot accept narrative momentum. They demand the level.
So Deutsche Bank does not cheerlead the economy. They rigorously, mathematically model explicit macroeconomic shocks.
The list of variables Deutsche Bank models reads like a catalog of anxieties that the oil lobby reports completely pretended didn't exist.
Deutsche Bank models upside surprises in inflation.
They calculate sovereign fiscal funding needs.
They model complex foreign exchange depreciation rates.
They analyze counterparty exposure. What happens if the institution on the exact other side of your massive trade suddenly goes bankrupt?
They look at changes in tax policies. They look at the frictional reality of currency convertibility in emerging markets. Like, can you actually get your money out of the country?
They even factor in settlement issues related to local clearinghouses.
They acknowledge a highly critical concept that index fixings might inherently lag or completely mismeasure the actual movement in the underlying variables they are intended to track.
It's so rigorous. They model the FX risk of funding a position in a currency different from the coupon denomination.
They analyze the specific, nonlinear risks associated with options on swaps. Swaptions, where volatility itself can literally destroy your margin overnight.
The contrast is blinding.
It really is. The oil lobby reports function exactly like a tech CEO's keynote,
A Plum built entirely on best-case scenarios.
utilizing a heavy trowel of omitted variables to hide the real-world friction.
But the Deutsche Bank report functions like the actual mechanics of gravity. It is the level that eventually, inevitably punishes those failed corporate forecasts.
That is the core takeaway for evaluating any claim you hear in this space. You must assess the incentive structure of the person handing you the forecast.
Always. Are they incentivized to be historically accurate?
Or are they incentivized to generate immediate momentum?
Which perfectly transitions us into an absolute masterclass in generating momentum while actively managing a massive divergence between intent and reality.
Oh yes, let's analyze Arvin Krishna and his massive reconstruction of IBM.
Arvin Krishna took over as CEO of IBM in April 2020. And the context of his ascension is vital here.
He inherited a mess.
He inherited a legacy technology giant that had logged roughly 19 consecutive quarters of revenue decline.
Just a slow, agonizing bleed. The broader market viewed IBM as this dusty relic of the mainframe era.
Exactly. So Krishna's mandate, his core Plum, was a violent pivot toward hybrid cloud and artificial intelligence. He had to return the company to growth.
Now, to be perfectly fair to his tenure, the stock is up 159% under his leadership. The market clearly bought the momentum.
They bought the Ashler.
But when you cross-reference his specific time-bound public forecasts with our Plum and level framework, the gaps between his predictions and the empirical market reality are staggering.
It starts with what the sources call the 2021 revenue illusion.
Walk us through the illusion.
So in January 2021, IBM reported a quarter where revenue had fallen 6.5%.
Bleeding continues.
Right. During that period, Krishna issued a highly definitive, unambiguous promise to the market. He staked his personal credibility on achieving revenue growth for the full year of 2021.
He explicitly stated, I want to measure the company on revenue growth.
A completely binary Plum. We either grow or we fail.
And theoretically, if you just look at the headline numbers, he achieved it.
Yeah.
IBM did report a sudden Q4 burst of 6% growth at the end of 2021.
However, the structural reality of that number was profoundly misleading.
It was an accounting trick, basically.
That top-line growth was heavily padded by an accounting artifact related to a corporate spinoff. Krishna was in the process of separating Kyndryl,
which was IBM's massive $19 billion managed infrastructure services segment.
Right. So the 2021 growth was heavily driven by incremental external sales of software and hardware to Kyndryl just prior to the official split.
They were selling to themselves, essentially, right before pushing it out the door.
Exactly. When analysts stripped away that artifact and measured IBM on a comparable inflation-adjusted basis, the per-year revenue trajectory actually continued to decline through 2025.
The underlying business was still shrinking.
It was.
So how does a CEO trowel over a missed Plum that he explicitly demanded to be measured by?
Through an executive technique called metric substitution.
Moving the goalposts.
Krishna never held a press conference to acknowledge that the top-line growth was reliant on the Kyndryl accounting anomaly. He didn't explain it.
He just stopped talking about it.
He simply stopped talking about top-line revenue. He quietly dropped it as the ultimate benchmark of his success. And he pivoted the entire corporate narrative to emphasize two specific submetrics instead: hybrid cloud annual recurring revenue, or ARR, and consulting signings.
He literally changed the scoreboard when the score didn't favor him.
It's a brilliant trowel.
And we really have to look closer at Kyndryl because the spinoff itself was an absolute disaster of forecasting.
Oh, the Kyndryl saga is fascinating.
When Krishna announced the separation in 2020, he framed it in unambiguously bullish terms. He promised the market he was creating two market-leading companies.
That's the Plum, market leadership.
Kyndryl officially launched and opened trading at around $31.50 per share in November 2021. And what was the level?
Brutal commercial reality. The institutional market immediately recognized that Kyndryl was structurally disadvantaged from day one.
A managed infrastructure services provider manages the physical servers and legacy networks for enterprise clients.
Which is a shrinking market.
Rapidly shrinking. It is directly cannibalized every day by the public cloud hyperscalers AWS, Azure, and Google Cloud.
Furthermore, Kyndryl inherited a massive debt load from IBM as part of the spinoff.
So the stock plummeted from the initial $31.50 to below $10 in 2022.
But the collapse didn't stop there. The sources detail that by February 2026, Kyndryl suffered a 50% single-day collapse.
Half its value wiped out in a few hours. This wasn't just market headwinds, it was a structural meltdown.
The SEC launched an accounting probe.
The company admitted to material weaknesses in their internal financial controls going all the way back to 2025.
They slashed their revenue guidance.
They abruptly replaced their chief financial officer.
And the stock cratered to roughly 72% below its 52-week high.
An absolute bloodbath. And what was Arvin Krishna's reaction to the implosion of the market-leading company he engineered?
Total narrative distance. He deployed the ultimate trowel of compartmentalization.
He consistently treated Kyndryl as an entirely foreign, independent entity, like he had nothing to do with it.
As if its struggles were completely outside IBM's purview, he completely ignored his own 2020 framing.
What's amazing is he would happily cite Kyndryl as a massive revenue multiplier for IBM when Kyndryl was contractually obligated to purchase IBM mainframe products.
But he offered absolutely zero public comment on the 2026 accounting crisis that wiped out shareholder value.
Take full credit for the sales you extract from them, completely disavow the structural failure of the entity you designed.
It's brilliant PR, but it's terrible forecasting.
But if we want to see narrative engineering perfectly aligned with market hype, we have to look at his claims regarding the AI workforce.
Yes, the AI jobs reversal.
The timing here is everything. Set the scene for us in May 2023.
In May 2023, the tech industry was in the absolute peak of the post-ChatGPT generative AI frenzy.
Pure mania.
Every CEO was desperate to prove they were at the vanguard of the AI revolution. During this peak, Krishna gave an interview to Bloomberg.
And he made a massive claim.
He confidently stated that he could easily see 30% of IBM's 26,000 back-office jobs getting replaced by AI and automation over a 5-year period.
Just wiped out by algorithms.
And to prove he was serious, he announced an immediate pause on hiring for these roles.
It generated massive headlines. Wall Street loves an efficiency narrative.
He positioned himself as the bold, unsentimental visionary willing to make the hard, AI-driven cuts.
But let's look at the engineering reality of back-office automation. Because an LLM is fantastic at drafting emails or summarizing a text document.
Right.
But it is decidedly not fantastic at navigating the highly complex, localized, and legally perilous nuances of enterprise HR disputes.
Or bespoke supply chain negotiations.
Exactly. Replacing 7,800 humans with an algorithm in a highly regulated enterprise environment is vastly more difficult than a Bloomberg soundbite suggests.
And the level proved this completely.
Less than 3 years later, by February 2026, IBM had not eliminated those jobs.
In fact, they had tripled entry-level hiring across the board.
Tripled. Krishna himself admitted to Axios in 2025 that total employment remained stable. The 7,800 job cuts simply never materialized.
He missed the forecast entirely.
But instead of admitting that enterprise AI adoption is slower and more complex than his 2023 maximalist claim, what did he do?
Krishna evolved his framing. By 2025, he began actively calling out AI boosters.
He specifically took shots at Anthropic CEO, right?
Yes. He accused him of operating in a reality distortion field.
That is rich.
Krishna positioned himself as the seasoned, moderate voice of restraint against Silicon Valley hyperbole.
He completely memory-holed the fact that he was the one making maximalist workforce automation claims just 2 years prior.
He became the firefighter heroically putting out the speculative fire that he himself poured gasoline on.
It's unbelievable. And this pattern of infinitely receding goalposts is probably most obvious in IBM's quantum computing roadmap.
Oh, the quantum roadmap. Let's go back to 2021. Krishna made a definitive prediction. Quantum computing would solve large impact real-world problems by 2023 or 2024.
Okay, we need to pause here because quantum computing relies on qubits, which leverage quantum mechanics to process information in ways classical computers cannot.
The engineering challenge is immense.
It's almost unimaginable. Qubits are incredibly fragile. They suffer from decoherence.
Right, meaning the slightest environmental noise, a fluctuation in temperature, a stray electromagnetic wave causes them to lose their quantum state and produce errors.
So did IBM hit the 2024 goal?
Technically, they hit their raw numerical target. They built the 1,000-qubit Condor processor,
Okay.
but they completely missed the utility aspect. Having 1,000 noisy qubits did not solve large impact real-world problems.
So Plum failed. They hit the vanity metric, but missed the commercial utility. How did they deploy the Trowel this time?
They simply redefined the milestones of success.
Metric substitution again.
Exactly. Raw qubit count was quietly de-emphasized in their PR. The new critical goalpost became error correction and fault tolerance.
And the target date for that.
The target for their fault tolerance system, which they dubbed Quantum Starling, was quietly pushed out to 2029.
And the audacity of the narrative management here is stunning, because by November 2025, Krishna was giving interviews literally describing quantum computing as being 3 to 5 years away from shocking people.
That is the exact same chronological time frame he gave back in 2021.
The Ashlar is a mirage that recedes at the exact speed you walk toward it.
Perfectly said.
I see the pattern. But I have to ask you to explain the market psychology here. Because we've listed revenue illusions, the Kyndryl collapse, phantom AI job cuts, delayed quantum utility.
Specific, verifiable failures.
Yes, verifiable forecasting failures, yet the stock is up 159%. Does institutional capital just not care about the truth at all?
Institutional capital cares about cash flow and structural momentum. The specific failures are forgiven if the macro narrative is moving in a profitable direction.
So as long as the line goes up, they don't care how you get there.
Right. Under Krishna, IBM's high-margin software segment grew from 25% to 45% of total revenue. Red Hat's ARR doubled.
That's real money.
It is. Krishna front-loads optimism because he understands that setting an impossible plum drives internal organizational alignment. He needs to force a legacy hardware company to become a software company.
So the Trowel works perfectly on Wall Street. Investors are entirely willing to accept deferred accountability on quantum computing or AI job cuts as long as the quarterly free cash flow continues to improve.
Exactly. But there is one area where the failure of the Plum was so massive, so publicly catastrophic, that a simple trowel couldn't fix it.
It caused lasting structural damage to IBM's brand equity in the enterprise space.
Yes. We have to talk about the Watson hangover.
To truly understand why IBM's recent generative AI strategy looks the way it does, we have to analyze the trauma of Watson Health.
This was the ultimate failed Plum of a previous decade.
IBM spent roughly $4 billion acquiring various healthcare data companies to build Watson Health. They dedicated 7,000 employees to the project.
The Plum was completely utopian. Watson was going to revolutionize oncology and cure cancer.
But let's look at why it failed structurally. Watson was originally designed to play the game show Jeopardy!
Right, which involves natural language processing to retrieve factual answers from a static database of rules.
But oncology is not Jeopardy!
Igniting clue.
Medical data is highly unstructured. Doctors' notes are subjective and messy. Patient histories are incomplete.
Biological edge cases are practically infinite.
And treatment protocols are constantly evolving based on new clinical trials. Back in 2011, before the advent of modern transformer-based neural networks, Watson relied heavily on massive manual tagging of data by expensive human medical professionals.
It couldn't intuitively learn a doctor's nuance.
And the level exposed that technological limitation ruthlessly.
MD Anderson Cancer Center burned through $62 million in a partnership with Watson and eventually shut the project down entirely after 4 years.
Yielding absolutely zero deployable clinical tools.
Hospitals in Australia completely abandoned the system after it began providing actively unsafe treatment recommendations for hypothetical patients.
Unsafe. It was recommending treatments that could harm people.
The commercial reality was so dire that in 2022, IBM Fire sold the core assets of Watson Health to a private equity firm, Francisco Partners, for roughly $1 billion.
A massive capital destruction. They lost billions.
But the financial loss wasn't the real damage.
No, the real damage was the Watson hangover. Because enterprise CIOs have incredibly long memories.
They don't forget getting burned.
When the generative AI boom exploded with ChatGPT, enterprise customers were deeply, inherently skeptical of any AI claims coming from IBM.
Because they just spent a decade listening to empty marketing promises about Watson curing cancer.
You can't just release a new AI tool and expect them to trust you.
Which required an incredible deployment of the Trowel by Arvin Krishna.
At the 2022 Bernstein Strategic Decisions Conference, he executed a masterclass in strategic reframing.
He discussed the Watson Health divestment, sure, but he claimed it had nothing to do with our commitment to AI.
How is that even possible to say with a straight face?
He framed the failure entirely as an error in corporate strategy, specifically trying to operate in a highly regulated vertical medical market where IBM lacked native domain expertise.
He explicitly refused to frame it as a failure of IBM's foundational AI technology or their forecasting ability.
It's a brilliant pivot.
It reminds me of a restaurant. If you own a restaurant and the health department shuts you down because you serve dangerously contaminated, highly complex fugu blowfish,
You have a massive trust problem.
you don't just put the fugu back on the menu the next day. You scrub the floors, you paint the walls, you reopen the exact same building, but you add an X to the name.
And you completely change the menu.
You change it from complex, dangerous seafood to the simplest, most boring grilled cheese sandwiches you can legally serve, just to prove to the neighborhood that you won't poison them.
That analogy perfectly describes the birth of Watsonx in 2023. IBM literally added a lowercase x to the name to establish a deliberate branding distance from the trauma of legacy Watson.
And look at their strategic evolution. They entirely abandoned the vertical moonshots, like revolutionizing oncology.
They shifted their entire AI focus to horizontal, deeply boring, highly measurable workflow automation.
They focused on IT help desk routing,
Automating HR onboarding paperwork.
generating boilerplate code snippets.
Exactly, because they realized they could no longer sell a utopian Ashler to the enterprise market. The Watson hangover was too severe.
They had to sell verifiable low-risk levels.
The failure of Watson forced a pragmatic recalibration of the entire company, even if the executive narrative refused to admit the depth of the initial technological failure.
All right, we have examined how narrative is utilized to cover up technical failures and financial misses. I want to pivot to a completely different kind of trial.
Let's do it.
I want to look at how policy advocacy and ethical framing are weaponized to manipulate market realities. Let's talk about Brad Smith at Microsoft.
And what the source documents term the diplomacy of concealment.
Brad Smith is a highly unique figure in the tech landscape.
Very unique. He holds the titles of President, Chief Legal Officer, and Vice Chair at Microsoft.
He operates as the primary public face of Microsoft's corporate policy, government relations, and social responsibility initiatives.
He very carefully positions himself as an ethical architect for the digital age.
But when you apply the Plum and level framework to his public campaigns, a very clear, really cynical pattern emerges.
Smith uses ethical public interest framing to aggressively lobby for regulations that serve Microsoft's direct competitive interests.
The sources highlight the Rural Airband Initiative, specifically focusing on the TV Whitespaces project. This is a staggering example of ethical PR masking technological failure.
In 2017, Brad Smith launched a massive public relations campaign with a deeply patriotic, morally urgent Plum.
He pledged to eliminate the rural broadband gap for millions of unconnected Americans, and he tied it to a highly specific symbolic date, July 4, 2022.
The technological foundation of this promise was TV Whitespaces, or TVWS. He hailed it as the ultimate game changer for rural connectivity.
He promised to have 3 million rural Americans connected.
Let's explain what TV Whitespace actually is, because the physics of it sound great on a whiteboard.
Right. TVWS refers to the unused broadcasting frequencies between VHF and UHF television channels.
Because these are lower frequency waves, they can travel over long distances and penetrate dense foliage and physical buildings vastly better than standard Wi-Fi or cellular signals.
It sounds like the perfect engineering solution for a rural farm in a heavily wooded area.
It does. Smith held massive press briefings in Washington. He aggressively lobbied Congress and the FCC to protect this spectrum for unlicensed use.
He painted an Ashlar of a fully connected, democratized rural America, all driven by Microsoft's philanthropic ingenuity.
So what was the level?
The physical reality of the technology crushed the Plum. The transceivers required to utilize TVWS were incredibly expensive to manufacture.
Because they lacked the massive global economies of scale that standard LTE cellular or Wi-Fi chips enjoy.
The ecosystem just never materialized. Furthermore, managing the interference with actual television broadcasts was vastly more complicated in practice.
By 2021, the National Association of Broadcasters issued a brutal assessment. They labeled the entire TVWS initiative a Google Glass-level disappointment.
That is a harsh burn in the tech world.
A full 10 years after the FCC authorized the technology and 4 years into Brad Smith's massive launch, there were fewer than 300 total devices registered across the entire country.
300 devices. Microsoft's flagship deployment network in Virginia reported having literally 0 devices deployed.
They missed the patriotic July 4, 2022 deadline entirely. The technology fundamentally failed to scale.
So how did the vice chair of Microsoft deploy the trowel?
He deployed the trowel by executing a silent pivot while rigorously maintaining the philanthropic halo.
Did he admit the proprietary tech failed?
Smith never issued a formal admission that TVWS failed. Instead, Microsoft quietly shifted the initiative to a technology-neutral approach.
They actually expanded the utopian Ashlar.
Right, promising to connect 250 million people globally by 2025.
But how did they plan to achieve this new massive number?
Not with Microsoft innovation. They plan to achieve it by piggybacking on massive government broadband subsidies like CARES and RRPA funding.
And by heavily partnering with Elon Musk's Starlink satellite network.
It is breathtaking. He swaps out his failed proprietary tech bet for federal tax dollars and a competitor's low Earth orbit satellites, but he keeps the PR credit for saving rural America.
And the sources point out this isn't an isolated incident. We see this exact same strategy, using public interest ethics to mask competitive maneuvering in his campaign during the 2007 double-click monopoly false alarm.
Oh, that was a classic. In 2007, Google announced its intent to acquire the advertising technology company DoubleClick.
Brad Smith immediately launched an aggressive, highly public, global campaign to block the acquisition.
He set a terrifying plum. He argued that the deal would give Google unprecedented monopolistic control over up to 90% of the advertising inventory in specific mediums.
Furthermore, he leveraged his position as an ethical architect to argue that the merger would create an apocalyptic privacy nightmare.
Effectively allowing Google to write a national privacy policy by default because of their sheer data dominance.
He painted a dystopia.
Yeah.
But the regulatory level proved his claims were entirely unfounded.
The Federal Trade Commission in the U.S. and the European Union regulators both investigated the merger deeply, and they cleared the deal unconditionally.
The regulators found absolutely no substantiated theory of competitive harm.
In fact, under standard antitrust definitions of relevant markets at the time, they didn't even consider Google's search advertising and DoubleClick's display advertising to be direct competitors.
What is vital to understand from these dossiers is a synthetic takeaway regarding Brad Smith's function. His title is President and Vice Chair, but his functional role is aggressive, sophisticated lobbying.
The ethical framing, whether it is protecting consumer privacy from Google or democratizing rural broadband access, is the plum. It is the shiny narrative object.
But the level is always, invariably, aligned with Microsoft's strict commercial imperatives.
Always.
Which forces a very uncomfortable realization. If you are an enterprise IT buyer, a federal policymaker, or an institutional investor, how on earth are you supposed to evaluate the claims of these vendors?
It's incredibly difficult.
When the individual standing on stage delivering the technological forecast holds the title of president but operates functionally as a lobbyist wrapping ruthless corporate strategy in moral imperatives, how do you trust the roadmap?
You cannot trust the roadmap at face value. You must ruthlessly separate the narrative from the math.
You have to actively hunt for the structural bias, exactly as we did when contrasting the American Petroleum Institute's lobbying reports with Deutsche Bank's risk analysis.
You must operate on the assumption that the perfected Ashlar being promised by the executive is not a guarantee of a specific technological outcome tomorrow.
It is a meticulously engineered tool designed to secure your capital, your compliance, or your regulatory favor today.
So, bringing all of these dossiers together, we have looked at AWS, Tesla, Intel, Salesforce, IBM, and Microsoft.
What is the fundamental core truth revealed by this meta-analysis of executive intent?
The core truth is that the massive divergence between executive intent and market reality is not a bug in the system of corporate capitalism. It is a primary feature.
The trowel is a standardized, highly refined corporate tool.
Whether you are analyzing Andy Jassy forcing enterprises to the cloud before the physics allow it, or Arvin Krishna padding revenue numbers with spinoff accounting artifacts, or Brad Smith masking failed technology bets with philanthropic PR, the pattern holds.
Accountability is almost always deferred. The corporate narrative is simply updated to reflect the new necessity.
A new, shiny Ashlar is constructed just over the horizon to justify the current failure, and the cycle repeats itself indefinitely.
So, to you, the listener, the next time you are sitting in a vendor presentation or listening to a quarterly earnings call or deciding where to allocate your company's IT budget, keep this framework actively in your mind.
Identify the plum they are setting.
Rigorously measure it against the empirical level of reality. and watch very, very closely for the trowel.
You must aggressively separate the narrative from the math.
Because if you make your decisions based on their promised Ashlar, you are the one who will eventually pay for the structural collapse.
That's the reality of the game.
I want to leave you with a final thought to ponder as we wrap up this deep dive. We've spent this entire session dissecting how human executives manage to escape the consequences of their failed predictions by constantly shifting the goalposts and deploying highly sophisticated narrative trowels.
Right.
But we are currently entering a vastly different technological era. As AI tools begin to generate corporate strategies, and more importantly, as those same algorithms begin to automatically, mathematically measure the execution of those strategies in real time,
Yeah.
will the trowel of narrative concealment become impossible to use?
That is a terrifying thought for a CEO.
If an AI strictly measures the empirical level of reality against the initial plum of the original promise, without any human capacity for PR spin, metric substitution, or silent pivots, will human CEOs be able to survive the brutal transparency of their own failure rates? Think about it. Until next time.